Hello, I'm Simon Roderick. I'm the Managing Director of Fram Search. I'm delighted to be joined by Keith Grindlay, who some of you may have seen before. Keith, how are you today?
Very well, thank you, Simon. Good morning.
It was very nice to see you a couple of weeks ago in the city, although, if I may say, a bit sad to see the city quite quiet.
It's certainly a lot quieter than what it had been pre-pandemic, but I guess more and more offices will start coming back. I spoke to one of our partners and recently, and some of the offices that he is associated with are still not back fully. Expected to be back in the office now. So it's taking time, but we'll see. But by the summer, I'm sure it will be a little bit more back to normal.
Yeah, we're back at Fram, so I'm recording today at home. Obviously, sort of talking today, so I want a quiet space. But we're back at Fram. We're working hybrid, so we're giving people a bit more control and a bit more freedom over their diaries. And I think that's working very well. But it is nice to be back in that team-based environment. Keith, before we talk about the economy, for those who haven't heard you before, just give them a brief overview, if you wouldn't mind, of your background.
Okay, so I run Macro Thoughts, which is a research strategy and consultancy company. My background was in trading for banks, UBS, Dresdner, and then at JP Morgan Asset Management, I ran global macro fixed income investments for the UK and for New York accounts. So Macro Thoughts is not purely an economic research company. We come from an angle of what this means to markets. We look at time horizons that can be short term, medium term, and long term, and we cover all asset classes.
Okay, so there's an awful lot for us to discuss this time. Things seem to, well, as always, seem to be moving very fast, but there's a lot of things you've touched upon before that are now starting to come to fruition. So it's quite difficult to know where to start. But let me start with the energy crisis, because I think that's something that it's going to affect businesses, consumers, and it's certainly hitting the front pages of the newspapers. How do you see the energy crisis playing out, Keith?
Well, I think the energy crisis is very much similar to other areas of industry, such as food prices. It's about supply, and it's about inflation in general. It is about supply shocks or the amount of supply being put onto markets. Obviously, geopolitical risks increase those risks, and hence we've got a spike close to $100. The question now is, at $100, what impact does that then have on growth? We've always maintained that there will be a recovery and that supply chain issues would be inflationary. We discussed that in August 2020. So we're not surprised that interest rates have gone higher, but now we're at the point where we start looking at the point where consumer pricing, when real average earnings are being affected, where food prices, for example, vegetable oils on the wholesale market has just reached an all-time high. Then that has an important impact on growth in countries such as India, along with oil, where India imports 83% of its oil use is imported. So that has a growth implication. And while inflation is the headline or the part that really affects everybody's headline news, as you say, there has to be a point where we start thinking, what is consumer reaction going to be? And we're seeing in the US, for example, consumer inflation expectations have risen, but equally consumer confidence has dropped. And we actually believe that in real terms, real average earnings is much worse, in that, for example, in the US, we look at real average hourly earnings when non-farm payroll and unemployment data is released. But that being average hourly earnings, like you say, a lot of the industries such as hospitality and leisure or retail are not back to normal. And these are lower paid industries. So that when you start seeing the participation rate in the US start matching the rest of the world and getting back to pre-pandemic levels, we'll start seeing perhaps lower real average hourly earnings and therefore more of a reality will hit with central banks that catching up with rate increases is not purely the answer to the problem they've got at the moment.
Do you think they moved too slowly on rate increases, Keith?
Yeah, we were adamant in June last year that the Federal Reserve and the Bank of England should have been tightening policies then. We were at the time. Don't forget, we're at a stage where we're taking the foot off the accelerator. We're saying, okay, less support for a pandemic, and in that environment, inflation has taken over. So we were strong in our thoughts that the Bank of England would be one of the first to start raising rates. We don't know why they made their hiccup, which was quite expensive for markets, in November. 15 basis point rate hike was incidental and more of an administrative amend. But now that, we had 4 members of the Bank of England talking about raising 50 basis points at their last meeting, it's questionable whether the Federal Reserve will go by 50 basis points next meeting. So they're front running and trying to catch up with rate increases while tightening financial conditions with QE policies being reduced and balance sheets being reduced. Now, this has a real liquidity issue for world markets, because already, we talk about central banks, or the main central banks like the Bank of England or the Federal Reserve or the ECB, but the Brazilian central bank has had multiple rate hikes, for example, and its 1-year yields have risen from 2 or 3% up to 12%. So this has a marked impact or slowdown to an extent on consumers, but equally, it means the cost of debt for governments and for corporates is going to be more expensive, and the cost of managing that debt will be more expensive, which then ends up in if you like, cost reductions at government level. And governments are already squeezing public sector pay and conditions already. How much do we start thinking about government job losses, for example? And over the next few weeks, we'll start considering in the US the debt ceiling again, and that could end up with some government shutdowns.
Yeah, I think it's very interesting. I know you look at indicators across the globe, but as you know, I'm concerned about this national insurance increase in the UK. It's on the face of it, it's not material, but I think coming back to what you're saying earlier around consumer confidence, mortgages or mortgage costs are going to go up. Some industries are not back to normal, and we're going to see a rate rise, which will affect some of the very small businesses out there. Equally, it's going to affect consumers as well, how much money they've got in their pocket. And so I think it's a very bold move at a time when perhaps growth is the real story. So I think I'd be interested to see how that plays out. And you said earlier too much supply chains. Do you think there is an easing in supply chains in terms of goods getting to store quicker and goods getting to the consumer quicker?
Well, we monitor supply chains, or have been monitoring supply chains for a number of years, even before the pandemic. So that we're at a point now where, for example, Biden has stepped in, and behind the scenes, probably the UK government has stepped in to try and improve the straight through supply of ships, containers, lorries, railway. And in the US, we started to see an improvement after Biden's intervention in August, but that change, if you like, or that improvement stalled in December and into January, possibly because of the Federal Reserve, possibly because of what was happening in China, and a lot of areas of China are being restricted because of they still have COVID issues. So that there was a period where we started to see a tightening of the supply chain again. For example, outside the LA ports, there was 109 ships waiting to be unloaded, and they were waiting for 19 days. That was a record. That has now dropped to around 80 ships. So we start seeing a sharp improvement, and we think that improvement will continue. As you say, we're getting back to some normality now. And it's definitely, we talk about inflation. It's the inflation shock that we've had is a supply shock. But equally, if you look at Maersk or the oil companies, or today, for example, Glencore, the companies, the big corporates, are still maintaining or even improving profit levels, which doesn't disincentivize them to start reducing prices until their demand level starts to hit, and then it starts to affect them. What we are seeing, unfortunately, is that that all of these companies are putting money back into buybacks while discussing job losses. And for example, that happened with Unilever. The Unilever CEO was talking about, we have to pass on higher prices because our shareholders will punish us if we don't. But at the same time, he was talking about cost cutting and job losses. Now, conversely, that's just starting to affect at supermarket level in the UK. So, for example, Asda have, under pressure from consumers or from consumer critics, have decided to move their basic food prices back to a year ago, to the level they were a year ago. Now that has a marked impact on supermarket, well, back to the days of supermarket price wars. If Asda are going to make subsequent reductions where they've reduced prices on their basics, such as pasta, tomatoes, for example, then we're going to start seeing that the price of food maybe in supermarkets come back down. The issue, it's quite interesting that for the first time, the BRC shop price index turned positive. And now, since 2013, it's only had 1 year where it was basically positive. So at actual supermarket level, because of competition, prices at food or at shopping basket level have been relatively stable in the UK, and perhaps we're going to get that sort of come back. I use an analogy that when you look at oil prices, or consider inflation. Inflation, you look at the price of petrol and how much it costs to fill a truck up and things like that. But the basket or the cost of a basket of groceries, when you start noticing that, that's when you start to really make your economies, and I think that's starting to happen now.
And talking about commodity prices, so oil, gas, staples in people's shopping baskets. Obviously, we can't ignore what's going on in Ukraine at the moment. And just before we came onto this call, I saw some what hopefully is good news about potentially a bit of a pullback of Russian troops from that border.
Yeah.
But we can't ignore what's going on in Ukraine. I don't think anybody's quite sure where this situation is going to go. What are the potential shocks of what we're seeing in Ukraine at the moment?
Well, the thing about the Ukraine, it's about the agreement that was made in 1997, and whether or not Russia wants to go back to the borders of that period. Yeah, there's a lot of saber rattling, and thankfully today it looks like the Russians are pulling back from the border, and it's affected oil prices for sure. But don't forget that between Russia and Ukraine, they export roughly 30% of the world's wheat supplies. So it would not only just be an energy shock, it will be a food price shock as well. And I don't think that was necessarily appreciated fully in the markets. And the turnaround, if you look at the UN FAO food price index, the turnaround, or the sharp turnaround over the last 6-8 months has I think even caught them out. And this has a natural impact, not just on developed economies, but certainly on emerging market economies, such as I mentioned earlier, India, where vegetable oils and price of onions are as important for the consumer, and probably more than the price of oil. So.
Yeah, so some potential shocks. So let's hope that's all going in the right direction, and that's been de-escalated, which is good news. Any other themes, Keith, looking forwards that we should be looking out for?
Well, as I say, we're at a point where we've always said that inflation expectations have been too underrated or have been too low. Growth expectations have been too optimistic, and we're seeing the likes of the IMF and the World Bank reducing their growth levels. And we still think they're too high. We're now in the US, for example, pricing multiple rate hikes. But interestingly, when in the US, something we've shown for the last 6 months is how flat the curves are getting. And while at the moment it seems to be the front end of the curve, which is pricing rate hikes and multiple rate hikes, and the Fed is doing its best to encourage this. At the back end of curves, which is the levels of 10-year yields in the US is back to 2%, for example. Well, that's a normal level, but we're talking about Fed funds now at 2.25. So rather than just ease back on rate hike or ease back on policies or eased policies, they're now hitting the brakes, and if you hit the brakes too hard, then that's going to have a marked issue down the road. And we are not of the camp that believes that we're going to have 7, 8, 9 rate hikes in the US. We're quite comfortable with 4 or 5 rate hikes. And it's interesting now that if you look at the short end of the US curve, that this actually starting to price rate cuts around 2024. Okay. So maybe markets are coming around to our way of thinking. In the growth story is going to start emerging. We do think that that this could have there could be an unemployment shock, where suddenly you'll start seeing unemployment start to rise and the unemployment rates start to rise, particularly in the US, where the participation rate should start to pick up. And again, it's producer prices. We've always said that while CPI is an issue for central banks, it's producer prices that are leading things higher, have led the prices higher. And we're noticing more recently that import producer prices are higher. For example, in the UK, last time they were 13.5%. But output producer prices are up 9.3%. So there are a margins issue that's starting to develop. We know that inventory levels are back to or becoming more excessive. Personal savings rates have dropped. Credit levels for consumers have increased quite to something, quite substantially. So if you look at margins. Okay, the S&P and FTSE will look at the big boys, the Glencores and the BPs, for example. But if you talk about employment in the US, for example, is about small and mid-sized companies that do the bulk of employing. And we saw on ADP last month how that was a bit of a shock. And non-farm payrolls was a good number. But we've kind of explained that in our recent report. But ADP itself was a bit of a shock that maybe brought markets up and has already been forgotten. Now, if that repeats itself in non-farm payrolls or in the next few weeks, and if you look at today's UK unemployment figures, they were pretty steady. They weren't, considering how many or the call for labour shortages, then I think that the labour market is beginning to relax from the shutdowns, and as we start opening borders up and having travel, then the tightness in labour shortages or labour market should start to ease a little bit. But equally, if we don't, we're going to start talking about the third phase of inflation. We're going from supply chains, we're going from corporate profits. We now start to see wage growth demands, and if central banks and energy prices and cost of food pushes hard enough, average hourly earnings, real average hourly earnings in the UK are 1+% lower, negative. In the US, real average earnings have been coming down for the last 9 months. So, in effect, this starts to have at the point where you start saying, okay, I need to get a pay rise for this. And if the shortages continue, then we're going to start seeing more demands. And, central banks are, if anything, stoking this inflation environment by raising rates, because the cost of credit, cost of mortgages, etc. Now, if you speak to estate agents in the UK, they're still optimistic. But certainly, I think that the Bank of England's threat of a 50 basis point hike has brought the market up short. And maybe houses, the big issue for the property market in this country is the shortage of new houses coming onto the market. And if anything, that's going to reduce the number of houses coming onto the market. If you're thinking, well, I don't have a substantial wage increase, bonuses are, well, okay, not a promise, I've still got a job in security. So, there's not everybody that can afford to suddenly start stepping up and moving house. So, while the government has given support, while there's been an incentive to move away from cities, and for example, then some of the estate agent expectations for price increases over the next 2 or 3 years look wildly optimistic to me. So maybe we're going to start seeing certain areas of the UK experiencing negative equity. And that will certainly start hitting, headline news, for example. So, in various areas that we're looking at, we think that growth is an issue that will be, by the end of the second quarter, will be an issue globally. I think that the central banks are playing catch up because they were well behind on the expectations for growth, for inflation. And now they're playing catch up. They risk tightening policies far too quickly. And if that happens, then the recovery could stall quite dramatically if we're not careful.
I think we've been through such an enormous shock with COVID, and obviously the response that we had to take to that there was obviously in certain economies a huge amount of government support to try and shield that, but there's inevitably going to be consequences of that, and probably the next 2 years I think are going to be very interesting in terms of how the economies rebalance themselves. I think we're going to see a huge amount of technology adoption as well coming into the corporate world. So it's going to be very interesting to see going forwards. Keith, as always, very good to talk to you. Thank you for your thoughts. I look forward to the next update with you.
Lovely.
Take care.
Thank you.